Ladies and gentlemen, good day and welcome to the Q2 FY21 earnings conference call of Ugro Capital, hosted by Dolat Capital. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Mona Ketan from Dolat Capital. Thank you, and over to you, ma'am.
Thanks, Sujita. Good morning, everyone, and welcome to Ugro Capital's Q2 FY21 earnings call. We have with us the senior management from Ugro Capital, including Mr. Sachindra Nath, Chairman and MD, Mr. Sandeep Jhawar, CFO, and Vivek Shashadri, Strategy Head. Some of the statements made in today's call may be forward-looking in nature and are subject to risks and uncertainties, which could cause actual results to differ from those anticipated. Such statements are based on management's beliefs and assumptions, based on currently available information. Audiences are cautioned not to place undue reliance on these forward-looking statements in making their investment decisions. I now hand over to Mr. Sachindra Nath for his opening remarks and highlights for the quarter, post which we can open the floor for questions. Over to you, sir.
Thank you. Good morning, everyone, and many thanks from all of us at Ugro for joining us for our Quarter 2 FY21 earning calls. As MSME have started resuming their operation across the country, we too have seen our lending to revert as close to normal as it is possible given the coronavirus situation. While we remain highly vigilant about the portfolio quality in these turbulent times, we also see the great opportunity in front of us. Fundamentally, a strong Indian MSME require capital backing now more than ever, and we are determined to answer their call and to expand our reach so that we can satisfy the requirement of maximum number of MSMEs. Our mission statement is to solve India's MSME credit gap, and we have been working tirelessly in this coronavirus period to develop new product and distribution strategies. The major theme for this is expanding our target demographic to focus keenly on micro enterprises. These bottom-of-the-pyramid firms provide livelihoods and employment to millions across the country, present a real pathway for impoverish to beat the poverty trap. We will be catering to these micro enterprises primarily through our new Sathi program and launch of our direct distribution branches in Quarter 3. Sathi refers to our range of secured micro enterprises loans, which are smaller ticket, higher yield, and shorter tenor than our traditional secured loans. We launched the program in October, and it has already seen great traction as the market demand for such micro enterprises loan is self-evident. Our direct distribution branches will be opening across 5 states in December. And unlike our intermediated distribution in our existing branches, these branches will feature Ugro sales personnel originating loans. These branches will be spread across Tier 2 and Tier 3 semi-urban locations and will thus allow us to greatly expand our potential customer base without cannibalizing any of our existing business lines. In terms of our existing distribution, we have further expanded our Grow Partner network to 518, which is a 32% increase on the Quarter 1 figure. Our short-term emphasis is on disbursing via our Sanjeevani program and ECLGS, as these represent the highest value proposition at this time. Till date, we have already disbursed over 100 crores through Sanjeevani and over 35 crores through ECLGS. As a nimble organization, we will always look to pivot to address the most pressing market arise. Our branch and ecosystem channels have fully reached their pre-COVID levels, and we are in the process of rapidly operationalizing our many corporate partnerships. We have had several of these partnerships go live on our proprietary partnership platform, Grow Extreme, and we are excited to fully explore all opportunities to create value alongside our partners. With regard to disbursal numbers, Quarter 2 has seen recovery to pre-COVID levels of disbursal, despite the many limitations still caused by the COVID. We have disbursed approximately 300 crores in Quarter 2, including 116 crores in September, which is on par with our pre-COVID numbers. We fully expect to continue our positive disbursal trajectory beyond our pre-COVID levels as we expand our branch network, introduce new products, and flesh out many more partnerships. We have reached a total of 1,697 crore disbursal as of end of quarter two, and our AUM stood at 970 crores with a blended yield of 14.4%. Our AUM is spread across 7,734 live customers for a highly granular average ticket size of 13 lakh. Our portfolio remains well diversified by sector and geography, and our book is roughly two-thirds secured. Our portfolio has a GNPA of 1.9% and net NPA of 1.2%, both of which are reasonable figures as our book has started showing some vintage. We have also maintained our conservative course when it comes to provisioning. We have increased it to 3.8 crore of COVID-19 specific provisioning and 11.8 crores of total provisioning, and this has led to our having had a large provisioning expense of 3.93 crores in Q2 FY21. Our portfolio is holding up well from the stress that is to be expected from a black swan event like COVID. Our collection efficiencies remain high, and we are in close contact with our partners or customers whose business may be seeing stress at these times. We are also looking at opportunities to selectively restructure and would do so wherever prudent. This quarter, we have started to see some early fruits of the strategic and operational improvement that we have been working towards since the start of pandemic. One very exciting development has been that we are one of the first lenders to be integrated on government's GEM Sahay platform. GEM Sahay is an online end-to-end marketplace for open, efficient and transparent procurement of goods and services by central and state government organizations. Through our integration, we will be gaining access to well over 2 lakh sole proprietorship and vendor ecosystem that supply a total value of nearly 20,000 crores. And we expect to see results from this integration from Q3 FY21 itself. We'll also soon be rolling out a new iteration of our Grow Chain platform, which we have built as a proprietary supply chain financing platform. On the liability side of things, we have continued to take great strides. The elevation of long-term liquidity crunch that was triggered by ILFS continues through government-driven schemes as PCG scheme and TLTRO 2.0. For well-run NBFCs, this has been a huge boon as it has allowed us to secure our liquidity position for the foreseeable future while borrowing costs have come down significantly, solidifying margins across the industry. This is an excellent timing for us as we will be able to leverage the large volume of liquidity that are now available to target aggressive growth, both organic and inorganically. As at the end of quarter two, we had a total of 578 crore of sanctioned liability lines, nearly 200 crore of which we have yet to draw. Our liability book continues to become yet more diverse, and now we have 16 active lenders, including PSU banks, private sector banks, foreign banks, and other financial institutions. We maintain a healthy liquidity position at present with nearly 300 crores of immediate liquidity on the balance sheet, not including our undrawn sanctions. This has meant that we have a CRAR of 86%, far higher than industry averages. Our liability pipeline is also very strong for the foreseeable future, and we are confident in significantly expanding our borrowing book as per our needs through the end of FY21. Our financial performance continues to be strong. We have notably recorded profits throughout this coronavirus period despite our highly conservative approach to provisioning. We have a declared profit after tax of 17.18 crores for Q2 with a total income of 34.82 crores. Our net worth as of September 30th, 20 stood at 943.9 crores, with our book value per share being roughly around 134 rupees. In closing, we believe that from a business perspective, the biggest challenge posed by the coronavirus have been successfully dealt with. Despite the continuing disruption, we have proven our adaptability as an organization and reattained our pre-COVID status quo in terms of distribution far sooner than anybody could have reasonably expected. We have spoken at length about our commitment to Indian MSME and our founding vision of solving the unsolved. As great Mahatma Gandhi had once said, an ounce of practice is worth 1,000 words. We have already added significant value to MSME space through our innovation, and we fully expect that the coming months will see us double and triple down on this impact once Aarti and our direct distribution branches go live. I hope that you will stay with us as we continue our journey. Thank you, and over to you, DART team, for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Dinesh Kotecha from CRIC. Please go ahead.
Sir, good morning to all of you, Mr. Chairman Sachinanand Nath and the entire team. So my question relates to only two things, sir. Number one is that if we come to slide number 11, we have added some 5 corporate clients. I mean, I would like to know, basically, what is the commitment amount and what is the mean and the max amount by the corporate clients which you have added? Also, we have reduced the ecosystem partners have gone down by 2. Now, any specific rationale for why that ecosystem partners have reduced? Any hitch between the eco partners? I would like to know that. Sir, I would like to know the delinquent accounts in the quarter 2, because 391 customers have been added. Any customer who has not paid a single paise. And other than that, for whatever efforts you are taking to set up, which was upset, in the first quarter, you are again setting it up in the proper manner in the second quarter onwards. I think things seem to be improving. Results are good. The provision has that deferred tax provision has added to the profit. I'm happy about it. And only thing is, the moratorium, what was set up by you for the clients and all that. I mean, how well is it restructured, or is there any changes in that moratorium period and amount and all that? Can you please explain a little bit so that more clarity will be appreciated, sir? Thank you.
Can you ask some specific questions, because there are many questions around that. So if I understand, so let me answer whatever I've understood in form of question. The ecosystem partners represent supply chain financing business. In our supply chain financing business, these are the partners through whom we finance the vendor, distributor, dealer ecosystem. And during this period, we have gone on a process of complete digitization, wherein we pick up the data from GST and banking. And in that process, some of our anchors partners, have decided not to participate and provide the data as per our underwriting norms, and those partners have exited. In terms of your few questions around moratorium restructuring, as we have said in our opening commentary, as of today we have not restructured much of an amount. You can see in our financial disclosures we have restructured total roughly around 7 crore worth of loans. But as you know that pandemic and its impact is an ongoing impact, and there is wherever there is a request from a customer, there is a complete recredit exercise which we do. And philosophically, wherein we think that there is a need for a customer to reduce cash flow, we have to match up the EMIs. We do it accordingly. We just make sure that the restructuring is not used for deferring the loan for businesses which are not in revival mode. So that broadly is the commentary. Anything else is specific?
Yeah, so I just want to add to that. Corporate partners for us is not limit even to corporate partners. It's essentially an origination channel for us, a partnership-based origination channel, which is essentially broken down into 3 parts. One is partnering with other NBFCs to co-lend through their channels. 2 is partnering with manufacturers so that you can provide point-of-sale financing for their end customers. 3 is partnering with B2B aggregators, newer fintechs of the world, to cater to their ecosystem. Right? So this is not a typical corporate lending that we are doing. This is essentially a channel for us, wherein we are catering to the MSME and MSME customer. Right? It's a B2B2C customer channel. Right. So there is no specific limit, because each of those cases are evaluated in its own merits. Right? The end customer.
Right. Sir, one more question to be added. That do we also provide finances to professionals? I mean, like doctors and chartered? Do we have
As
that
you
channel?
know that we are focused on our 8 specified sectors.
Okay.
Within that 8 sectors, healthcare is one of the sectors, and within that those 8 sectors, we do roughly around 75 to 100 subsector, and we look at the ecosystem around that.
Right.
So we do provide financing to the doctors, but that's specified to certain segment of the doctors. So we do for dentists, we do for IVF clinics, so on and so forth.
We don't provide loans to chartered accountants as a segment for now.
Yeah. So thank you very much, because I appreciate the effort which you and your team has undertaken in the second quarter, and I hope that this goes on, increasingly to show better performance in the Q3 and Q4 and the year ahead. So thank you very much.
Thank you.
Thank you.
The next question is from the line of Janish Sheda from Dimensional Securities. Please go ahead.
Yeah, sir. Good morning, sir. There are a few questions. One, you said about your Grow partner network and corporate partners, where you do the co-lending and all. So I just wanted to know what are the key terms in those contracts, like how you do the revenue sharing and who bears the risks. Secondly, you have 9 branches and 194 employees. So what are the number of employees per branch? So, sorry, you want to...
Go ahead. No problem.
So you need to look at that set of employees between broken down into corporate and broken down into branch, right? Okay, first break it down into sales and then break it down into non-sales. So if you look at it, of the 180 odd employees, around 60 to 70 will be in sales, of which each of our branches will have around, all the 9 branches have around 45 employees. The remaining are the business development team for our partnership-led alliances, for our ecosystem-based lending channels, and so forth. So each of the branch will have currently around 5 to 6 people in sales. Okay. So the rest of them are the HO employees, or they are? No. So then branch-led is only one of the channels for us. There are 3 other channels that we operate in. One is the ecosystem lending channel, which is our supply chain, wherein we cater to vendors, dealers, distributors of mid-corporates. So there is a team, the sales team dedicated to that. Then there is a partnership-based distribution channel that we have. As I mentioned before, we cater to large machinery manufacturers to cater to their end customers, fintech companies to cater to their MSME clients. For instance, if there's a payment gateway and there is merchants on that payment gateway, we cater to them. So the third team is for those kind of alliances. So the total sales team will be around 70 to 80, of which 45 are branch sales team. Okay. And in terms of your terms with your network partners and your corporate partners, what are the revenue sharing and the key risks? Who bears the risk? Yeah. It varies. It varies differently.
So if you look at what we call a channel is called partnership and alliances. Now in partnership and alliances, there is a very small NBFC with whom we are co-lending. So we don't lend to NBFCs, we only co-lend with them. Or if there is a payment network or there is a fintech, they each would be varying depending upon. So the role and responsibility, we expect the partner to do origination, do customer service and collection. And depending upon, they apply our risk framework, and sometimes we do the assessment of their risk framework. So it depends upon what kind of risk sharing arrangement is there and what is the role and responsibility, and it accordingly varies. So there is no uniform way which I can give it to you.
Yeah. So, I mean, there are 2 broad metrics, if you will. One will be if the partner is involved only in disbursal, then there's a percentage of the disbursal amount that he gets, which varies depending on the type of loan that he has. And then supposing he's participating in the risk as well, which is essentially giving us a first class cover, then there is a certain interest sharing also that we do. If that makes it clear. So 2 broad types of partnership payouts, but then getting into the specifics of each would mean going down into each of our 4 distribution channels, and there are 5 variants in each of those distribution channels as well. All right. We'll take it offline. Thank you so much. Yeah.
Thank you. Ladies and gentlemen, to ask a question, you may press star and 1. The next question is from the line of Vikram Rana, an individual investor. Please go ahead.
Well, congratulations, sir, on a good quarter, considering the current market environment. So just quick 2-3 questions what I had on the mind looking at the presentation. One is with respect to the quality of the loan book. Now that the book has started becoming vintage, we can also see the NPAs have increased, the gross NPAs specifically have increased from close to about 1% to 1.9%. So could you please throw some light on that, about the increase in the gross NPAs?
So as you rightly said, that a book is now showing some vintage, and obviously, the period has been very, very turbulent. We think so. This is coming to the normalcy curve. Our general belief is that, and what we are seeing in the portfolio in terms of collection efficiency, our customer responding, amount of emergency credit line, availed by them, and the moratorium data, and that our portfolio is quite resilient at this point of time. We are not seeing any surprises from where we are today.
Yeah, a lot of it is due to COVID as well, wherein there are temporary delays in cash flows, and therefore you will see delinquencies going up a little. But the fundamental thing to note is a large percentage of our portfolio is secured in nature. We are working with these customers. These customers are slowly getting back to normal. For instance, just take a school, for example, right? Although schools are functioning now, the amount of revenue that they're collecting has come down a lot because they are not collecting on any of the ancillary revenue, if you will, right, which is transportation, books, uniforms, where the margins were larger. So we are in touch with each of our customers. We understand why each of them is struggling right now. And basis that, if there are customers we believe need that support, we will provide them the support during this period of time.
Sure. I think that was pretty comprehensive. And another thing what I wanted to ask is basically, I think you also mentioned in your presentation that, the Grow Extreme is something which has now become operational with multiple fintechs and partners. And I believe that is for the co-origination part of the business, right? And now given that pre-COVID, we had signed about 3 co-origination packs with the banks. Has that started off now?
So our Grow Extreme, so just to give you, we have 5 platforms which we operate. So Grow Protect is our central platform. So we don't fashion ourselves saying we are a fintech, but because I think that term is not well understood. But I think our entire business is all about digitalization and technology at the center of it. And our rule engine on the underwriting is supported by 4 different products. One is Grow Line, which is our supply chain platform. Grow Plus, which is our intermediation platform. Grow Direct and Grow Extreme. Grow Extreme has both elements, so it is an upward and downward co-lending module. On the upward side, we have 3 banks, 4 actually, 3 banks and 1 NBFC, which is already 3 of them have been signed up partnership, and 1 is getting integrated now, which is Bank of Baroda, ICICI, Kotak, and Poonawalla Finance. So all of them are already there. And on the downward stream side, obviously there are many number of fintech NBFC partners are coming. As all of us probably know, that the co-lending which RBI and the banks are very keen that should start in India, have been facing operational challenges for quite some time. Last week, RBI has revised the guideline on co-lending, and we are very hopeful that under the revised guideline, which is like an on-tap direct assignment, some of these good banks would become functional. It is also a function that we have enough and more liquidity for ourselves to lend out of our own balance sheet itself. But it's still, from a long-term strategic perspective, we would like some of these partnerships to become active now.
Right. I think, thank you, sir, for that answer as well. So just one last thing, as you mentioned, right, during the opening statement also, that, the cost of borrowing now has started coming down. So I just want to understand what will be an incremental cost of borrowing looking at a weighted average at close to about 10.5%.
So the way, sir, you should look at it is that the current cost of borrowing is also a function of lot of liquidity measure which has been used by RBI as well as Government of India, right? So majority of the benefit of that pre-COVID we didn't had a single public sector bank or a large private sector bank as a financer to us. But during the COVID period, because of our strong balance sheet and quality of portfolio governance management, we saw all of these lenders to come to us. So today we have around 7 public sector banks, 2 large private sector banks, multiple small finance banks, and foreign banks are already there. So the current cost of borrowing which you see on the balance sheet is a function of this excessive liquidity which has been provided. We don't know whether that would be the rate going forward, but What we are seeing is that there is enough and more liquidity for good companies, and we will continue to draw liquidity for our current year's need, and we don't see a challenge. And it should be in the same, more or less same range. That's what our target is.
Right. And so one last question, if I can squeeze in, just to end up. So what is your target AUM now for FY21? Looking at things have started going back to pre-COVID levels to an extent. So maybe anything on that front, and how do we actually plan to reach that number?
So sir, we don't give hard numbers, I think so, but you can draw
some ballpark something, yeah.
Absolutely. So what you should look at is that we have said in our opening commentary that we are not showing too much of exuberance given where the markets are, and underlying SME customers are still quite stressed. But the run rate disbursement which we are seeing, we will definitely maintain that disbursement, and there should be at least some 10 to 20% incremental disbursement rate should come during this year.
Sure, sir. Thank you, sir, and wishing the whole team happy Diwali.
Thank you. Same to you.
Thank you. The next question is from the line of Gauri Ahuja, an individual investor. Please go ahead.
Yeah, hi sir. Thanks for taking my question. So I feel like we've been lending out to 8 different sectors. Wanted to understand that what is the current exposure to all of these sectors, especially like hospitality and education that are stressed right now. How have you kind of mitigated that risk? And are there certain sectors that are actually engaging in a higher level of moratorium coverage and certainly witness more restructuring going forward?
No, okay. If you look at our, it is given in our presentation. Our sectoral exposure is quite well diversified. Education consists of 19, light engineering is 21, electrical equipment is 14, hospitality is 13. So your specific question to hospitality. So in hospitality, we finance multiple subsectors in hospitality, fast food chains, fast restaurants, small, so on and so forth. Except one or two odd cases of banquet hall, so on and so forth. We are obviously there is a reduced cash flow in hospitality, but majority of our portfolio remaining secured, and some of these customers have enjoyed the emergency credit line facility. We don't see much of a problem, but we are cautious in terms of our incremental disbursement. We are very cautious with respect to hospitality, but on our existing portfolio, it's fine as well.
Okay, sir. And any plans on expanding to, lending in all of these 8 sectors going forward?
Sorry, what is the question?
Sorry, I just asked like a follow-up on that. What are the plans to expand lending in all of these 8 sectors going forward?
We are, right? So we have started disbursement back. So as we have said that auto component around 5 quarters back, we have gone very, very slow. Hospitality, we are very slow. On a long-term basis, I think the post-COVID, we are still positive on each of these sectors. You cannot generalize. So as I said, in hospitality, a banquet hall today is more suffering than a fast food chain, right, which is all doing home deliveries. Same way in auto component, 4-wheelers are still little stressed, but 2-wheelers are doing fine. And we, as you know, we do the bottom of the pyramid of that. So we continue to disburse across our sectors, and a sector which definition which we have added is what we call micro lending sector, wherein the sub 15 lakh rupees of loan, we don't think so that there is an homogeneous effect of a sectoral impact, and then we treat that as a separate sector. So our program like Sathi and our direct distribution is designed for micro lending segment, and we continue to grow in all of them.
Okay, sir, right. That answers it. So, sir, a few last things. Just wanted to see, like, since you've expanded to Sathi and your direct channels as well, congratulations on that. How are you adapting to new customers right now? Like, what is the strategy behind it?
So I think the one of the competitive advantage Ugro has is its centralized technology, proprietary technology platform and data analytics. Unlike other conventional traditional lenders, when they enter into micro lending segment, they continue to start from a pure physical footprint of branch, which we will also have, but they don't have the data analytical capability to benefit from what we have done. So when we started in our prime segment, we invested heavily in our tech platform, and those platforms are now being customized to look at micro lending. And obviously there is a refitting of the underwriting parameters, because our prime segment underwriting was largely bureau driven, and we have customized bureau data to a sector bureau's proprietary score called Grow Score. and then we have Grow Expert, which is subsector operational scorecard. So we're using combination all of that, and using this into an underwriting filter, which fits into Sathi and our direct distribution program.
Sure, sir. Thank you for answering that. Just one last thing. We understand you have different distribution channels, around 3 to 4. What are the spreads that you're enjoying in all of these, just for my knowledge?
So we don't do spread by channel. We do spread by product. We have given in our presentation, you can see our gross yield across secured and unsecured supply chain. And that should be the best way to look at it.
And let me just again shed some incremental light on that. So the way you should look at it is by channel and by product within those channels. If you look at our branch channel, again, that's broken down into two parts. The branches that we have in Tier 1 cities, which are the 9 branches that we have right now, and the direct branch that we are opening up in Tier 3, Tier 4 kind of cities. In the the secured in the Tier 1 cities will obviously be lower. So we do secured at 12.5, and unsecured at around 18-19. Whereas in the Tier 3, Tier 4 cities, the secured and the unsecured are 20% plus, right? So the spreads you can backward calculate from there. On the ecosystem channel, again, two products there. Vendor side financing is at 13.5, and dealer distributor would be around 15.5, 16%. Then you go to your partnership-led strategy there. There, I think the rates are very different depending on the risk participation from the partner's side as well. For instance, if he's giving me X% of first loss, then obviously I'm able to bring down the rates to that effect. And if there is no first loss, then obviously the rates are 18 to 20 odd percent. Then the last one is the digital channel, wherein the rates are again 20% plus, but that channel for us is currently on pause given COVID.
Right. Thank you so much to both of you, and happy Diwali.
Wish you the same.
Thank you. The next question is from the line of Shinay Kothari, an individual investor. Please go ahead.
Hi. So, as your AUM is around 960 crores, so how much of that is still in moratorium, and what percentage of that has still not paid a single installment, basically? And what do you expect, like going forward, how much of that book will go bad?
So, let me take that. In the first moratorium, and I'll just answer that question because I don't have the exact data point, but I think you'll get the answer with this one. Okay. The first moratorium, there was 83% in moratorium, which was out for us. The second one was an opt-in, wherein it was 61 to 62. September and October have been no moratorium one, and almost the collection efficiency has been 90 to 95% plus, right? So there are very, very, very few customers who have not paid a single EMI. It will be less than 1%, 2%.
All right. And going forward, how much of that book do you expect to go bad?
So as we sorry, Vivek, as we said in our statement as well, that the COVID-related provisioning which we have done, what we look at data today seems to be more than sufficient for covering any form of. So obviously, some of our customers would undergo restructuring. As of today, what we have said that during this quarter, we have restructured roughly around 7 crore worth of outstanding loans. And restructuring does not mean that these customers have gone bad. These are the customers who cash flow have got reduced, and we have just adjusted for their cash flow and either increase the tenure or reduce their EMI. We think so that process would continue till March 21. But we don't expect that our total outstanding portfolio which will go through the restructuring would be more than 6 to 7% of our outstanding POS as of September. And the provisioning required for that would be sufficient vis-a-vis our COVID provisioning.
Yeah, and the other thing to note about the restructuring that we are doing is we are not offering anybody a moratorium, if you will. What we are trying to do is make sure that the customers are paying so that the habit will change. But then if the EMI was X, maybe they are paying 0.75X of EMI, right? So that's the only change that we're bringing to our portfolio.
Okay, thank you.
Thank you. Ladies and gentlemen, to ask a question, you may press press star and 1. The next question is from the line of Mona Ketan from Dolat Capital. Please go ahead.
Hello.
Yes, Mona.
Yeah, hi, sir. So, on this unsecured portfolio, which is about 1/3 of your loans, could you throw some light as to how you manage risks in this book, and are we incrementally also lending to this sector?
So look, our unsecured business is a combination of many things. When we look at an SME customer across our different distribution channels, we do both secured and unsecured kind of financing. Now, all our loans, whether they are secured or unsecured, are based on the underlying cash flow. The assessment of cash flow, most of our unsecured business is for prime customer, wherein we test, at a filtration level, we filter these customers on bureau. Then this get tested on our proprietary scorecard, which is a modification of bureau by sector. And then it is done, cash flow underwriting is done by underwriting teams using our data analytics tool and the efficient underwriting method. And that is the reason that while our unsecured portfolio has also shown the same level of resilience as the secured portfolio, even sometimes better than that.
Yeah, unsecured portfolio collection efficiencies were more than 95%, if I'm not wrong.
Yeah. Second, in terms of whether we are incrementally doing that business or not, answer is yes. We have not stopped lines of secured and unsecured, but we also match like enterprise or related level. There is size of the portfolio to be collateralized, and that's why collateral. We are gradually collateral. So from residential mortgages and commercial mortgages, we are also starting machinery-led mortgages, so on and so forth. And given the current time, we are trying to restrict the unsecured pool disbursement across our total disbursement pool. But it is not that we have stopped that.
Okay. And will it be fair to say that the gross NPA levels are similar across both secured and unsecured books?
I would presume that unsecured is less. Vivek, is that right?
So, in fact, the most of the delinquencies that you see is just like we're confident that we'll be able to easily make it up. It's in the partnership-led channel and the ecosystem-led channels, a lot of whom have FLDGs and those kind of protections as well, right? So, in our traditional secured unsecured channel, the delinquency is almost next to nil.
Okay. And these are again not new to banking because you're using.
No, as of what portfolio you are seeing today, have no new to banking customer. But when we start our direct distribution branches, which are 25 branches this year, next year we will increase from that base, which are being started in 5 states, in which we are already present. There, we are building the right to all this customers. It's up 10 lakh, and some of them would be new to banking.
Okay. And the collection efficiency number of 95% that you mentioned for the unsecured portfolio, that will include the past arrears as well?
Sorry? No. So this is even
only
the past
for the
arrears. Yeah, only for the month.
Okay. And what would be the overall collection efficiency for your portfolio?
I think it will be in the 90% kind of range. I don't have the exact numbers.
Okay. And this is again excluding the arrears. So basically the collection efficiency is lower for the secured portfolio versus the unsecured.
No, as I said before, there are different channels. The branch-led channel has a very, very high collection efficiency, north of 95%. It's the other two channels wherein there is some delay. Those, again, that's the reason we are very confident that we'll be able to rectify this.
Okay. And, sorry.
For instance, supply chain, right, wherein there are certain delinquencies that are coming because of late payments, so on and so forth, which anyway, the large anchor still remains. Therefore, they are confident that the cash flows will return.
Mm-hmm. Okay. And under the ECLGS scheme, how much have we sanctioned and disbursed so far?
That number is there in the presentation. Give me a second.
38 crores.
Yeah.
Okay.
38 crores as of September. उसके बाद I think we're done incremental 10 crores or so.
Sure. And lastly, also on this education portfolio, which is about 19% of your loans, you did throw some light in a pre-question, but just wanted to understand a little bit more around, how this portfolio is behaving and, I mean, given that schools may not open for a longer period related to the rest of the economy, what is your take there?
Sorry, I didn't get you.
The education institutions is about 19% of your loans, if I could see in one of the slides.
Correct.
Yeah, so just wanted to get some color on this book because it may take longer than the rest of the economy to open up if my understanding is correct.
Correct. So as I told you before, but our schools are not affordable. The schools that we have been to are not affordable private schools, right? These are tier 1 cities. These are not operational in the traditional sense, that is physical schools aren't open, but everybody is doing online classes. So schools haven't shut down, right?
Okay.
Hello. There is payment coming from them. Maybe, as I said before, instead of maybe collecting the entire payment, we may be collecting some part of it, but payments are still coming. All the loans in the education sector are completely secured in nature. So that is the comfort that we have. So education as such, we don't expect too much of problem.
So, Monash, adding on what Vivek said, that so education, K-12 in place, very, very, probably 1 or 2 cases. On the K-12 side, unlike affordable, when you go to tier 4 down, then obviously the very dramatic, because neither those students can apply and students can pay fees because of job loss and so on. Versus our schools are tier, some of the allied fees of the schools, transportation. For education income is one of them would be.
So your voice is breaking. We can't hear you very clearly.
Okay, is it better now?
Yeah, better.
So I was just adding that the K-12 school in tier 1 town, there is a marginal decrease of their income because of the allied line of fee incomes have reduced, but the core line of educational fees are still coming to them, and that's why we are seeing collection happening.
Sure. Thank you. That's from my side.
Thank you. The next question is from the line of Sumit Balotia from MK Ventures. Please go ahead.
Yeah, hi. So I have a few questions. Is it possible for you to share SMA 012 numbers to have a better understanding of the collection efficiency trend in, say, October?
SMA 01, we won't have that often. I don't think so. We published that also as of yet.
We don't.
For portfolio,
you can get an understanding, like you mentioned, that less than 1% collection efficiency number. You mentioned that you have not paid would be less than 1%, or you have paid more EMI. So something on those lines.
Louder, can't hear you.
Hello, can you hear me now?
Yes, now very well. Yes.
Yeah. So what I'm saying is that to understand the calculation of collection efficiency better, if we can get some ballpark figure of overdue amounts in, say, 012, SMA 012, that will be helpful. Some ballpark figure will also do.
I'll tell you what.
Sure. So let's come back offline on this because we don't have the numbers handy with us right now.
Okay, no problem. Second question is on the PCLBS extension which the government has announced yesterday. So we have disbursed on 38 CR as of now. This extension of the timeline as well as the turnover limit, would that affect our portfolio?
No, and most of our customers don't belong to that category because that extension, obviously time extension is fine, but the extension to 50 to 500 crore, our customers don't belong to that segment.
But there is an extension given for loans which were overdue or SMA 0 also till February 20. Would that impact us?
No, so some customer may become eligible because of that. But as we said that we use emergency credit line with a full recredit exercise. So yeah, some customers would become eligible, but would be very small portion. I don't think that should
because delinquencies are very, very low at that point in time. So I don't think there were too many excluded customers. The reason why the entire set of customers have not taken up emergency credit line is two. For one, they did not want it. Two, after looking at their numbers, we felt we shouldn't give it to them, right? So we have almost covered all of our customer base through that exercise.
Okay.
So I don't think there's going to be any incremental, maybe a very, very small amount, but nothing clear.
Understood. But thirdly, on the liquidity that we are carrying on our books, which is around 300 crore. Now, as a percentage of AUM, it is, I would say, among the highest, within the NBFC space, much higher than what others are carrying. Typically, that from earlier, other NBFCs, they are around in the range of 15-20%, and everyone has now brought it down. So what is our strategy going forward on this liquidity that we will carry on our books?
As a younger institution, our view is that even at the expense of carrying negative cost, we are in the build-out phase. We are building relationship with the liability side. And once you are in that mode, you don't say no whenever a new large bank comes in, give you a sanction. That's point number one. Number two, if you look at our stated policies, that we carry 2 months of forward disbursals onto our books all the time. And I think so for the current year, we will continue to look at that. Obviously, it is a cost of roughly around 18 odd crores of negative carry for the year. But we think that once we post FY21, when we get to the scale, the lending relationship which we are now creating with some of the largest institutions in the country would help us to scale far better. So, and that's why we are taking this cost right now.
Okay. Okay. And lastly, on this co-lending model, maybe I might have missed out if this is already discussed, but just wanted an update on where are we, what is the progress, and what kind of monthly numbers we are doing currently, if we are doing it, and how do you see it changing going forward?
So co-lending Grow Extreme has two parts. As I say, downward, upward. Upward is the three partnership with the banks which we have: ICICI, Bank of Baroda, and State Bank of India. In last pre-COVID, we were about to start with Bank of Baroda, but because of COVID, it got stopped again. Now we have reworked with new programs, and technology is getting integrated. The recent change done by RBI actually, and hopefully, should open up co-lending in big time, because now they have divided the co-lending into part committed and non-committed, and it has become kind of an on-tap direct assignment. So let's see. We continue to deploy a dedicated team to service these large banks and work very cohesively. But as a strategy, we are not engaging new lending institution on co-lending, because we are 4 of the largest banks of the country are already signed up partnership with us. So our aim is that we activate that as soon as possible. On the downward side, obviously, there is we have now on live relationship with 4 or 5 small NBFCs, 3 fintech and payment platform, 2, 3 marketplaces. And hopefully in next few months, we should see a run rate of around 15 to 20 crore a month is our gut feel.
Okay. Okay, thanks so much. Yeah.
Thank you. The next question is from the line of Shigar Walia from OHN Group. Please go ahead.
Hi, thanks for this opportunity. My question is with regards to the Sahay program, do we have any target or a guidance, etc., in terms of what kind of numbers can we look at?
Sorry, which program?
The GM Sahay, this thing.
GM Sahay? No. So I think that we did mention that in terms of showcasing our technological prowess, because with the very established large lending players, we still was the first one who were able to integrate to a very complex, technological solution, which is driven from the Oken, which has been launched by Nandan Nilekani, and GM Sahay being part of that. We will be soon integrating with account aggregation. So point being that we wanted to showcase that we are at the forefront of technological innovation and fintech evolution, if you may want to call, in terms of our how we are operating today. In terms of the number, actually, if you look at the reported number that, GEM platform, the total procurement have been roughly around 3 lakh crores or so. Obviously, we have devised the program. It should go live by mid of next month or end of next month. In terms of volume, reason I don't want to give you any number because it's early days. So we want to see it completely operationalized. And this is the first time a purchase-based financing program is being run. And also, it is also a matter of pricing because today, as an NBFC, we have integrated in partner, but our view is that government very soon would push some of the large public sector banks to integrate there. Once they come in, the price would drop dramatically. So obviously, we don't want to do this business at below a threshold price. So we will see some traction, but we are not. We didn't made that comment thinking that would be a large portfolio. In our current disbursement run rate, we are not dependent upon some of those things at all. If they happen, then they are bigger upsides to us.
Okay. My next question is on our 500 plus Grow partners. What percentage of the overall business is sourced through these? And if you can give more color in terms of the geography profile or what kind of KRAs are there for these and the profile of these partners?
Yeah, absolutely. So we operate into nine locations, and we were operating 75-kilometer periphery from these 9 locations. So if we are present in Chennai, so we were operating a 75-kilometer periphery. Post-COVID, actually, we have increased that penetration to 150 odd kilometers. So we have doubled up our physical or geographical coverage area. The Grow partners are a combination. So the way we say we want to Uberize the intermediation channel in India, 80% of Indian prime lending is originated by traditional DSAs or connectors or few other sets of people. Majority of our current Grow partners are people who are traditional DSAs or loan referrers. But given our platform, because these people take to our platform, take a tab, go to customer, upload banking and GST, and can get a sanction in 60 minutes, yes and no. We constantly increasing this channel to go to non-traditional intermediaries, people who otherwise have customer but have not done lending intermediation business. But the current profile of these are focused around these 9 geographies, 150 kilometers around that, and people who have experience of doing loan intermediation. Most of these intermediaries would not just be intermediary to us, but would be intermediaries to some of the largest bank and other large NBFCs as well. The reason why they do business and operate and come to us because of the efficiency which they receive. Because this is completely digitized channel. Our turnaround time is very fast, so it is beneficial for them. Though our approval rate continues to be quite low because we are still very conservative in terms of our underwriting processes.
Okay. And so in terms of for these 9 branches, these 500 plus partners are enough, or are there any specific targets to increase this number?
So, sir, as you say that that's a constant journey. We continue to increase, and also we continue to flush out some of the partners which are not active. The way we have seen that the intermediation in India works, that there are certain it is divided between large national aggregator, localized player, and referrers who refer it to either an intermediary or a bank. And the channel is then divided by secured, unsecured, and also by product category. So, for example, with the Sathi program, which is our sub 50 lakh ticket size program, this is a completely new set of intermediaries which you have to bring on board, which we are doing. So I think our channel would expand to roughly around 700 plus. And the additional new intermediaries which are coming are only for Sathi program. Versus our Sanjeevani program, which is our both secured and unsecured, our existing channels are servicing that. So in summary, this is the number of channel partners will continue to increase depending upon, how you are expanding the portfolio. And there can be variety of kind of people who will come on them.
Rightly. And broadly, the percentage of AUM that is sourced through partners?
So so we have 4 channels, right? So what we call the Group Plus or intermediated channel. Our secured and unsecured business, 100% is today sourced through intermediated channel.
Okay. Thank you.
Thank you. Ladies and gentlemen, as there are no further questions, I would now like to hand the conference over to Ms. Mona Ketan for closing comments.
Thank you all for joining us for the call and the Ugro management for the opportunity to host this call. I hand it over to Mr. Sachindra Nath for his closing remarks.
Thank you, Mona. And thank you all of you for taking out time and listening to our quarterly results call. And I wish you all a very, very happy Deepavali. Thank you.
Thank you. On behalf of Daulat Capital, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.